Australia's Tranche 2 reforms expand the AML CTF regime in a major way. And for the first time, a large group of professions and service providers will be required to comply with customer due diligence obligations, often referred to as CDD, when providing certain designated services. So if you are a lawyer, accountant, real estate agent, conveyancer, corporate service provider, or you operate in a profession that has never had to do this before, this video will give you a clear and practical overview of what customer due diligence means, how it works under the Tranche 2 rules, and how to apply it using a risk-based approach. In this video, I will cover what customer due diligence actually is, why it matters under Tranche 2, the 3 main levels of due diligence, how to identify and verify individuals and companies, how to apply a risk-based approach, 5 practical examples including high-risk scenarios, and record-keeping and ongoing monitoring. Let's get into it. Customer due diligence is the process of confirming who your customer is and assessing whether the customer presents a money laundering or terrorism financing risk. The objective is simple. Before you provide a designated service, you must understand who you are dealing with and whether the transaction or relationship makes sense. Under the Anti-Money Laundering and Counter-Terrorism Financing Act 2006, as amended, and the AML CTF rules, customer due diligence is not one size fits all. Instead, the level of due diligence you apply must be proportionate to the risk. So if the risk is low, your due diligence may be straightforward. If the risk is high, your due diligence must increase. Under the Tranche 2 framework, reporting entities generally apply one of 3 levels of customer due diligence. First, initial customer due diligence. This applies at the start of the relationship, before you provide a designated service, and it focuses on identifying and verifying the customer and assessing the risk. Second, simplified customer due diligence. This applies when the money laundering risk is low. You still verify the client, but the checks are lighter and proportionate. Third, enhanced customer due diligence. This applies where there is a higher risk of money laundering or terrorism financing. And the key point is this: you must decide which level to apply using a risk-based approach. Under the AML CTF Act and rules, you generally must complete initial customer due diligence before you provide the designated service. In some limited cases, you may be allowed to complete it as soon as practicable afterwards, but you should not treat that as the default position. Customer due diligence usually involves 2 core steps. Step 1 is to identify the customer. This means collecting information such as full name, date of birth, residential address, and other identifying details. For a company, it may include the company name, ACN or ABN, registered office, directors, and ownership information. Step 2 is to verify the customer. This means confirming that the information is correct using reliable and independent sources. That may include identity documents like passports and driver licenses, corporate registry records, or electronic verification systems. The method you choose must be reasonable, based on the risk and the nature of the relationship. A risk-based approach means you assess the likelihood that the customer relationship could be used for money laundering or terrorism financing. Some common risk factors include the nature and purpose of the customer relationship, the customer's source of funds or wealth, international elements or cross-border activity, and the industry or sector involved. Your risk assessment is what drives the level of customer due diligence you apply. Now let's make this practical. Example 1. Tim is a 38-year-old Australian resident who contacts his local law firm for help buying his first home. He is employed as an engineer. His income comes from salary and wages paid into an Australian bank account, and there is no adverse media or international exposure. A routine sanctions and politically exposed person screening is completed, and there are no concerns. In this scenario, the firm assesses Tim as low risk and applies simplified customer due diligence. His identity is verified using a passport or driver license, and the firm records the steps taken. Example 2. Levi is self-employed and operates as a sole trader in mining consulting. He receives income from both domestic and overseas sources. Screening returns no concerns, and there is no unusual behaviour. But overseas income introduces additional risk, so the firm assesses Levi as a moderate risk and applies simplified customer due diligence, plus targeted inquiries about source of funds and nature of business activities. And importantly, the firm stays alert in case enhanced due diligence becomes necessary later. Example 3. A real estate agent is approached by Sarah, a 22-year-old casual shift worker who wants to buy a unit for around $850,000. She says she will fund the deposit using cash savings. Immediately, the agent sees a potential inconsistency. Sarah's age, occupation, and the size of the transaction do not naturally align. Sarah provides ID documents, and they are verified electronically. But when asked about the source of the deposit funds, she gives a vague explanation and cannot provide evidence. At this point, the agency assesses the risk as high and moves to enhanced customer due diligence. After further inquiries, Sarah provides evidence that the funds came from a deceased relative's estate, including a solicitor's letter and a certified copy of the grant of probate. Screening returns no matches. With the risk now reasonably explained and supported by reliable documents, the agency records the enhanced measures and completes onboarding. Example 4. An accounting firm is engaged by Jack to establish a family trust, but Jack does not deal directly with the firm initially. Instead, his financial advisor Jill provides instructions. The firm identifies Jill as a representative and requests evidence of her authority. Jill provides a signed authority from Jack. The firm then identifies and verifies Jack as the underlying client. It also asks questions about the intended purpose and activities of the trust. Screening is completed on both Jack and Jill, with no concerns. The firm assesses the risk as low and records its customer due diligence as complete. Example 5. A corporate service provider is approached by a newly incorporated company, Orion Global Solutions. They want company secretarial services and help establishing offshore subsidiaries. The inquiry comes through an overseas consultant. Ownership appears complex, involving foreign corporate shareholders and nominee directors, and the beneficial owners are unclear. Screening returns no direct matches, but the structure and cross-border activity are high-risk indicators. The provider requests further information including source of funds, purpose of the structure, and confirmation of ultimate beneficial owners. Delays and inconsistencies in responses increase the risk profile. So the provider applies enhanced customer due diligence, verifies beneficial ownership through independent sources, and applies increased scrutiny before providing services. Everything is documented in line with the AML CTF Act and rules. Once customer due diligence is complete, your obligations do not end there. Reporting entities must keep records of identity verification, risk assessments, screening results, and enhanced due diligence measures. Ongoing monitoring may also be required to ensure customer information remains current and transactions remain consistent with what you understand about the customer. So to summarize, customer due diligence under the Tranche 2 rules requires a structured and risk-based approach. If you identify your customer, assess the risk properly, apply the correct level of due diligence, and keep clear records, you will put your business in a strong position to meet compliance obligations and manage exposure to money laundering and terrorism financing risk. For practical guidance, tools, and resources to help you meet your customer due diligence obligations, visit flagshipaml.com.au. Thanks for watching.